I'm Sonali Basak, financial correspondent for Bloomberg Television and Bloomberg News, and I'm so delighted to be joined today by Mellody Hobson, who's the co-CEO and president of Ariel Investments, and John Oxtoby, who's the director of ESG investing at Ariel. Thank you both for joining us.
Thanks for having
So,
us.
Melody, I'd love to start with you, given your role as not only at the head of Ariel, but also on the board of corporations across America, chair of Starbucks, on the board of JP Morgan. When you look at this past year and moving forward, what to you is the most significant way you think the role of a corporation is changing when it comes to ESG matters?
What I would say is ESG is front and center in corporate America in a way that it hasn't been before. I tell people this is not a fringe issue. The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community and the broader society. What has changed also is that some of these conversations have really surfaced in a new and different way. And I think that that has left corporations with um, no other choice but to engage around a number of these issues because again they're being asked by various constituents.
So, you had mentioned investors as one of those stakeholders, right? And John, this is a great place to get your opinion on this. We're seeing, BlackRock's Larry Fink just saying to our team this morning, activism, right? We are seeing, others like Newberger Berman vote with their feet this proxy season. I know it's a big question among our audience as well. How can investors use their own power during this annual meeting season to create change, especially around sustainability issues?
Well, that's a great question, and you're right. In the larger ESG conversation, there has been a lot of focus on these large passive or thematic strategies, and perhaps a little bit less on the role of active managers in pushing companies forward on these issues. And we're seeing a unique dynamic in the small and mid cap space in terms of the sustainability and ESG conversation relative to that of the larger companies, where you're reading headlines every day about new net zero targets, for example. But many small cap companies that we invest in don't have a single full-time resource dedicated to ESG, let alone climate. So the point is, long-term investors with strong relationships and access to management teams can play a really important role putting ESG on the agenda and offering up best practices. So in this way at Ariel, we work collaboratively with the companies in our traditional value strategies to encourage management teams to strengthen their ESG policies, practices, and impacts.
Well, that gives a good, you had mentioned small and medium-sized companies. Large companies have come out and made all of these, promises about net zero and others, right? Melody, what are some very tangible things you're seeing among your peers in the industry also that are changes that others should learn from?
The first one I would say that is near and dear to us at Ariel are statements and then actual backup around issues related to diversity and inclusion. We've seen a couple of things that I think are meaningful that can ultimately affect real change over the long term. The first is that you're seeing more pay tied to outcomes related to diversity. And I've been saying this for years, you get what you incent. So seeing those incentives aligned to the outcomes that companies say are mission critical to their future is a very, very good thing. The second thing that you're saying is certainly more transparency around these issues, where companies have been more willing to publish data around where they are as it related, again, to diversity and inclusion, statistics and numbers and targets that they have. And thirdly, targets. There was this debate around targets and quotas, and I've been a big proponent of targets. We're seeing people set goals, which is what we do in corporate America when we want to be able to measure our success, set goals around these issues. So while in so many ways this would be obvious, it's great to see these practices finally come through and ultimately be more widely adopted.
It's worth asking both of you really. When it comes to ESG, how do you balance the different competing issues that are in that really broad bucket of investing, right? How do you balance social issues and environmental ones, and make sure that when you're both investing in companies and Mellody advising the boards that you're on, that they're taking all of this into consideration in every business decision that they make?
Well, I'll say it this way, and then of course I'd love John to chime in, but all ESG risk for each company is not created equally. And so there are different ESG factors that are more meaningful from one company to another. And that's how we would think about it as an investor. So you're not trying to say on every issue, we're tracking you, because every issue may not be relevant to that business. John can take it from here, but this is a more nuanced discussion than I think most people really realize.
Yeah, that's exactly right. And I would just point out, we look at ESG really through a lens of financial materiality. So for some companies, environmental issues are going to be more material for a given company. In other industries, social issues are going to be more material, and performance on those issues is going to be different and more important in certain industries and certain issues than on others. So that's really something that's aligned to what we're seeing best practices in the market, whether it's incorporating the SASB Sustainability Accounting Standards Board framework, or other best-in-class frameworks that we encourage our portfolio companies to be disclosing on, and we tell them that we're tracking their performance on.
Well, yeah, on
And
that
I
note
really
too.
think it's worth underscoring one thing that John said. It's not our personal beliefs here. We're taking a risk-based approach as investors. I think that's a very important point to make, so that people don't think we're leading with our own personal agenda.
Well, why don't we elaborate that on a little bit? What do you mean by risk? If you invest in certain areas that do pose these risks, right? Just by nature of example here, because what is at stake for you as an investor if things don't change?
Well,
Well,
I'm
I'll
happy
let
to give
John
a
go on this one.
yeah. Well, happy to give an illustrative example. So take a company like Brinks. They're a leader in secure transportation and cash management. Brinks clearly faces significant transition risk with its large vehicle fleet, climate transition risk. So we're discussing these issues regularly with the senior management team, including the company's plans to mitigate these risks and to adapt its business model for a low carbon future. We're providing real-time input. We're providing advice on their ESG journey. So anywhere from adopting, expanding their ESG disclosure, to setting what are the appropriate metrics and targets, understanding their strategies to reduce their emissions through lighter vehicles, cleaner fuel sources, expansion of electric vehicles, route efficiency. Again, this is a good example of how investors can help put ESG issues on the agenda, and encourage companies to take real change.
Now, that it's a great example you had given too, because one of my major questions is how does, the green investing category at large start to change under the Biden administration, right? There's been a lot of heat around investments, electric vehicles, for example. I mean, are there very specific areas you see, John, that can really attract investor capital on the heels of what we're seeing in Washington?
Absolutely. You mentioned electric vehicles. This is an issue that we're following closely. EV infrastructure investment is not just going to be relevant for companies like Tesla and GM and battery companies, but it's also going to be relevant for not only Brinks, like I just mentioned, or other companies with large vehicle fleets. Stericycle is another company, the medical waste services provider in our portfolio. So it has real implications for those types of companies. It also has implications for companies that have exposure to the electric vehicle supply chain. So for tools manufacturer Stanley Black & Decker, for instance, greater adoption of electric vehicles is a growth catalyst for its automotive fastening business. They're seeing 2 to 4 times more content potential for EV and hybrid vehicles than they do in their internal combustion engine business. Axalta is another good example of this. They're an automotive paint and coatings company. Electric motors are going to require many more insulation coatings than compared with the internal combustion engine. So that's another example of a growth opportunity that's really tied to this opportunity. And both of these examples, I think, are just great, evidence of how we think about things at Ariel, how our bottom up rigorous value investing process then intersects with some of these more macro ESG trends.
And one of
No,
the things
another
they
question.
also show the examples is that you raise the political piece. These companies are thinking about the bottom line. That is what is driving the outcomes that we're talking about. It's not about who's in the White House. It's about over the long term, what's in the best interest of the business. And again, that's the lens through which we are looking as investors.
Can you help me understand kind of the power of the investment community and how it works as it bands together on certain issues? John, you had mentioned Exalta. In my mind, that's a company that's changed private equity hands, right? You've seen it go through multiple phases. This upcoming weekend, we have Warren Buffett's annual meeting too. They're facing shareholder votes and resolutions. I spoke to George Walker of Neuberger Berman about this last week, and the idea of getting more investors on board with certain causes. When you talk to your peers in the community and the investment community, what are some ways that really there are power in numbers when it comes to seeking changes that, as you say, Mellody, will ultimately impact the bottom line, right? What you guys get out of this at the end.
Well, I'll start
Sure.
and I'll say at least my conversations with our peers is that ESG is very much on the front burner. Even for companies that don't hold themselves up as ESG managers, they are incorporating ESG questions in their conversations with management. They are incorporating some lens through which they think about ESG in what they're doing in ways that have not existed before. When we look at presentations of our peers, their pitch books, you're seeing pages devoted to ESG. So it is now getting further embedded in the investment process in firms in real time. And we're going to see that collective attention ultimately have a lot of potential power and influence over the long term. Of course, people like Larry Fink have been out front on this issue for a long, long time. But it's now starting to coalesce, it seems to us, to be a broader industry conversation.
I do want to shift gears just a little bit because I want to talk about the importance of measurement. And I'd love both of your opinions on two different areas, actually. John, maybe starting with you on measurement when it comes to green issues, because we are at the forefront of I know Mellody had said it's not about who's in the Washington, but there could be significant changes here in terms of what investors get when it comes to disclosure. John, as an investor, what do you need? What are the metrics that you would like to see in this kind of new era of disclosure?
Sure. Well, we're seeing lots of momentum and progress on this front, and we're encouraging companies to put out material ESG disclosure aligned to the SASB framework. We're encouraging companies to set environmental targets. And there's an important distinction here that we should also make between the small and mid-cap side of the market and some of the larger companies. A lot of small cap companies have not even yet started reporting greenhouse gas emissions, let alone set GHG reduction targets or reported material ESG disclosures aligned to SASB. So, and as you might expect, small cap companies are underrepresented among those who do report SASB disclosure. And it's a pretty big gap. So small cap and micro cap companies represent over 75% of the companies in the Wilshire 5,000 total market index, for instance, but they're only 25% of SASB reporters. They're only 18% of those that are setting science-based targets. So again, they're starting from a lower base, a lot of these smaller companies along their ESG journeys, but we're seeing a lot of momentum and progress. In our own traditional value portfolios, between 2019 and 2020, we looked at the number of companies that have set science-based targets or provided SASB-aligned reporting. That has increased by a factor of 6 over that 1-year period. And in 2021, we're already seeing this really start to take up steam as well. So as we continue to have these conversations with management teams, I think you're going to see that gap start to close much more as the whole economy really realizes that providing this type of exposure for investors really is decision useful, and investors are going to continue to demand it.
Mellody, I'm curious about your thoughts on this too, on the social front, because we are seeing this era where on one hand, you see companies, particularly banks, putting forward new metrics that we've never, even as reporters, have been able to access before. Now, but you also have them fighting back against, for example, independent audits. I do want to grab your opinion here on, what are the right rules of the road here? But also, I mean, you also mentioned something about quotas, right? Do you think there really should be quotas when it comes to kind of improving workforces? Because, it's something that I think a lot of people are talking about now in a way that they hadn't been in the last couple of years.
So I'll take up the issue of quotas first and say that I'm not for quotas, I'm for targets. Because I think targets are very much in the language of current corporate America's nomenclature. And so we have earnings targets, we have profitability targets, we have all sorts of targets. They're ranges. We don't guide to one number. And I think that is appropriate when you talk about diversity and inclusion issues, that you have a goal, and that goal gives you a range and some flexibility to meet the goal, which is again what we're used to. So I'd like to stay within the realm of what we have adopted as policies and procedures on other things that we measure inside of corporate America, which is why I like targets over quotas, where it's a hard number and it's a make or break issue with a quota. When you talk about third-party audits, again, these issues get nuanced. I think they're different by industry. I think in the banking industry, it's so heavily regulated. There's so much there that is already reported. The third-party audit, to me, is less relevant than in certain other industries. So I think, again, there's no science to this. We're still in a maybe the artful phase of ESG, and we're trying to get more and more precise and more scientific around data and metrics. But it's not a one-size-fits-all approach. It's one thing that I've said, and we at Ariel have said from the very, very beginning.
So, I think this speaks to a lot of what you're saying. When we polled our audience, they had said, when asked if green investments yield better returns at the end, about 30% said yes, about almost 30% said no, and more than 40% said it depends on the investment. Right. So, that depend on the investment part of it speaks to a lot of what you guys are saying. And John, maybe you can help build some parameters here about, how you define this across different companies. And really, what we're talking about here is push that needle forward.
Sure. Yeah, again, and we touched on this earlier, we really look at ESG through this lens of financial materiality. So for those companies where environmental issues pose greater material risks and opportunities, performance on those issues are going to be even more important. Now, I would also highlight, we're very active consumers of the latest research in this area. I would highlight research from HBS Professor George Serafim that's found that firms with good performance on the most material sustainability issues have significantly outperformed firms that have poor performance on those issues. So that does suggest that that type of performance on these material issues can be shareholder value enhancing.
Mellody, is there anything you could say about, are there specific industries, as you had mentioned, it's different across industries, that are doing better when it comes to sustainability and environmental issues than others right now, that there's something to be learned from?
I don't know if it's a question of doing better. I think maybe there are questions around more intention and more stated intention right now. So obviously a very clear and simple example is we're seeing it come out of the auto industry and the statements that are being made about their emission standards and how they're going to change over the next decade or two. But very bold statements have been made about combustible engines and basically them going away over time. So that would be an example where the whole industry, I think, has taken to the issue and is changing in real time and is being more deliberate in stating what their goals are. And every day you hear about a new one from a big auto manufacturer. So it's not a question of better. It's just, I think there are people who are in different phases of this journey, and we will see it unfold. And as I keep saying, we're seeing it unfold in real time right now. And I think, 5 years from now, this will be a much different discussion than it is today.
So here's another question from the audience, and one that relates to me as well. It's, we're seeing ESG, and I wonder if you even agree with this or not too. The last couple of years, there's been a lot of focus on the E in the ESG, and more recent support around the S in terms of dollars, as it goes into more social programs and social good as well when it comes to investing. how do you manage the intersectional approach of diversity, inclusion, and ecological concerns? I mean, what is your framework that you could provide other investors into be putting those dollars into both places with the best possible return on that investment?
Well, I'll just start by just saying that for years I used to say that ESG to me, if I were to actually draw what it was, to show people where the emphasis was, it would be a capital E and a smaller case S and G, because I thought the E had really overwhelmed the S and G, and they weren't standing there as equals as I think many intend them to be. But John can speak directly to how the D&I and the ecological concerns can be at times considered together.
Yeah, I mean, I love the premise of the question because too often these are viewed as different silos that aren't interrelated and don't recognize that texture and nuance to it. Take the issue of climate change. This is not just an environmental issue, this is an equity issue. The faster that we can transition to a low carbon economy, the more we're going to avoid the worst potential effects of climate change and their outsized impacts on our most vulnerable communities. You saw this with the Texas blackouts recently, where communities of color were by far the most impacted. So that's just one example of how climate is just as much a social justice issue, a social issue, as an environmental issue. And I think the other point that we would make, and my colleague Leah Yablonka and I published a piece in the Chicago Booth Review, the academic journal, last month on this, on the importance of racial wealth inequality. A lot of the evidence points to the racial wealth gap as having major implications intersecting issues of health and housing and education and ecological and environmental justice types of issues. So these are very interrelated. And I think in particular, looking at the wealth gap and what we can be doing to tackle this is going to be a really important part of the conversation looking forward.
Mellody, I'd love to give you some closing thoughts on that too, because this is something I know we're all grappling with this year.
Well, I was going to say, to that point, I've made the point on many occasions that the social unrest that we have in our society has a huge component of it is economic. It is economic inequality that leads people into the streets. It's the racial inequality is clear, and we see it front and center right now in terms of the differences in outcomes for people of color in our society in a myriad of scenarios. But one big underpinning issue that exists in all of these conversations is the economic inequality. And until we actually deal with that, we will have persistent problems in our society.